Welcome to The Explainer. Look, if you've been watching the markets between August 10th and 14th of 2026, you know things have been moving at an absolute breakneck pace. We're looking at a historic collision right now. You've got intense geopolitical heat in the Middle East crashing right into this unstoppable AI wave, all while the mighty US dollar completely loses its footing. It is a textbook perfect storm, and we're going to break down exactly how it played out across every major asset class using the raw data straight from this week's market reports. The overarching narrative from the reports this week can really be summed up perfectly by this one quote: "A market storm as the Greenback surrenders to geopolitical heat in the AI wave." This isn't just about one stock ticking up or down, right? This is a massive macro narrative. We've got three huge forces: geopolitics, AI, and shifting central bank expectations twisting together and basically bending the traditional rules of the market. And it's fascinating because when the dollar surrenders like this, those shockwaves hit absolutely everywhere, from the gold sitting in your portfolio to the oil powering the global supply chain.
So, to make sense of all this chaos, here's our roadmap. First, we'll look at the US stocks breakout. Then, we're pivoting over to the dollar's demise before things heat up with commodities on fire. And finally, we're going to tie it all together with a strategy we're calling the cheap money party.
All right, let's dive into part one, the US stocks breakout. Wall Street just had a phenomenal, record-breaking run this past week. But as we'll see, there's some serious underlying tension brewing beneath all the celebration.
So, the S&P 500 closed at a staggering 7,785 points. That is a historic all-time high, right alongside the Dow Jones. And the driver here? The market is absolutely convinced that inflation has finally cooled off. Both PPI and CPI data came in lower than expected, and man, that optimism was so powerful that investors just completely ignored the pretty weak retail sales data we got on Friday. They looked right past it and drove a third consecutive week of gains.
But wait, there's a hidden danger lurking beneath all this euphoria. When you really dig into the market internals, a bearish structure has actually formed, and it's genuinely dangerous if folks stay blinded by the excitement. The source actually issues a critical warning here. Next week, the S&P 500 is likely to trade sideways briefly before potentially dropping down to a target of 7,730 points, with the Dow expected to weaken significantly alongside it.
Now, the tech sector tells a slightly different story. The Nasdaq 100 closed at 30,050 points, keeping its overall upward momentum intact. Look at the AI infrastructure sector. It's just an absolute sea of green. Giants like SMCI and NVIDIA exploded right back onto the scene, totally shielding the broader index and keeping that tech outlook looking pretty bright heading into next week. Which brings us to our second theme, the dollar's demise. Because while stocks were popping champagne, the currency markets took the absolute biggest shockwave of the week.
The US dollar index, or DXY, experienced a literal cliff drop. The Greenback completely surrendered, falling to close at 99.64 points. It evaporated 0.6% of its value in just 2 days. Investors are aggressively repricing the market right now, fully expecting the Fed to make drastic, heavy-handed rate cuts. This sheer loss of value really confirms that the DXY is going to continue to weaken, and the source notes that falling well below that 99-point threshold is basically just a matter of time now.
So when the US dollar sinks like a stone, who rises to the top? The Canadian dollar. The USD to CAD pair plunged roughly 2.7% from its late June peak, dropping all the way down to 1.3872. It's a crazy contrast. While the US dollar was getting absolutely crushed by Fed rate cut expectations, the Canadian dollar was getting pumped full of life by surging crude oil prices. This dynamic actually allowed the CAD to completely outperform its G10 peers.
And that perfectly transitions us right into part three, commodities on fire. Because all that massive weakness in the US dollar, it directly translated into rocket fuel for the commodities sector.
Both gold and WTI crude oil are showing some aggressive upward momentum, but their journeys this week were a little different. Midweek, gold faced this classic sell the news pressure drop right after the PPI inflation report came out. But bottom fishers rushed right in, pouring cash back into gold and forcing a really quick recovery. Oil, on the other hand, its climb has just been relentless, almost defiant against the news cycle.
And the numbers back this up massively. Gold is currently up an astonishing 32% year over year, basically riding the perfect combo of a depreciating dollar and high global risk. Meanwhile, WTI crude oil grabbed a net gain of roughly 8% just this week alone. And what makes that 8% jump so wild is that oil did it while completely ignoring the bad news. US oil inventory report showed an increase in supply, which, normally tanks the price, but the market didn't care at all. The price just kept surging.
So what gives? Well, here's the exact reason why oil closed at $82.40 a barrel despite that inventory build: the geopolitical risk premium. This is that extra price baked into an asset because of the threat of war or regional instability. According to the source, the geopolitical risk premium in the Middle East is being pushed to its absolute maximum right now. It's basically acting as a titanium shield for oil bulls, and it's the sole reason the overall trend for oil is projected to just keep climbing.
Okay, let's bring all these threads together. We've gone from macro data down to the micro charts, and now it's time to synthesize everything into the final verdict for the upcoming week. Welcome to part four, the cheap money party.
Based on everything we've just unpacked, here are the highly actionable forecasts right from the source. First up, gold. Look to enter sell orders early next week. The source gives a specific target price region of $4,274 per ounce, noting that silver is probably going to follow a similar downward trajectory. Second, accumulate crude oil. Because of that massive geopolitical risk premium we just talked about, its upward trend is heavily solidified. And finally, exercise extreme caution with US stocks. I know we're seeing record highs, but please do not let the euphoria blind you to those underlying bearish structures forming in the S&P 500 and the Dow.
Which leaves us with a final, vital question to ponder as we close out today's explainer. Will this cheap money party, driven by falling rates and an AI boom, actually sustain the market's record highs? Or are those hidden structural cracks we saw beneath the surface of the S&P 500 about to break wide open? Keep a close eye on the dollar and those geopolitical headlines, because they definitely hold the answer. Thanks for joining me today, and I'll catch you next time.